Advanced Financial Accounting OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to a consolidated statement of cash flows. We're going to be using the direct method, and we'll also have a reconciliation of consolidated net income to net cash provided by operating activities. Get ready to account with Advanced Financial Accounting. Here we are in OneNote. If you have access to OneNote, and you're not required to have access to OneNote, you can just follow along with it. But if you have access and you want to follow along within it, we are on the 1029 tab under the problem presentations. We're going to go over the information first. We'll go look at all the information, and then we'll pull pieces of that information as we go through and work our problem as we put together our statement of cash flows. So we have the information. P, purchase percent of S on January 1st, 2000 X0, common stock, 75%. P is going to be the parent. S is going to be the subsidiary. Purchase at book value, so we don't have any differential to deal with. Fair value of non-controlling interest in common stock, 25%. 75-25 breakout. Consolidated trial balance at January 1st, 2000 X2 and December 31st, 2000 X2. We will see those shortly, and we'll be using those to make our statement of cash flows. Statement of cash flows using the direct method. So we're going to be using the direct method. Dividends paid to P are P paid dividends, parent paid dividends of 33,000, subsidiary paid dividends 23,000. Here is going to be our worksheet. So we're going to have our worksheet. I would put this is the format I would recommend putting it in place. I'm not going to spend a whole lot of time, saying why I put it this way, in this way, or in this format with regards to standard statement of cash flows, because we do have a course on the statement of cash flows and you can spend some time on that. We're mainly focusing in here on those things that are going to be different, those things that are going to complicate things with regards to the consolidated information as opposed to just one company doing a statement of cash flows. But we will go into some of this kind of worksheet information. So we're going to have the two periods. We're going to have the beginning period, January 2000 X2, or you can think of it as the end of the prior year. We basically have a post-closing trial balance, or in other words, we're basically taking the balance sheet and looking at it in terms of a debit and credit format. We can see then that there are no income statement accounts down below, just the balance sheet accounts. Then we're going to have the current year as of the year end, December 31st, 2000 X2. Same kind of thing. We're going to have all of our information, trial balance information. And in this case, we do have the income statement accounts, and then of course the net income, which is including the income for the non-controlling interest here. Then our first move is to take the difference. So now this column, you might assume this column to be the sum of these two columns, considering we've been working with consolidations. But this is already the consolidated balance sheet, the consolidated trial balance as at the beginning of the year, the end of last year, and the end of the year. These are consolidated already. So this column represents our worksheet for the statement of cash flows, which takes the difference, which is going to be one of our fundamental building blocks to creating the statement of cash flow. So in other words, we have, for example, cash, the 113,500 minus the prior year 81,500. That means it increased 32,000. 101 minus the 86 means there's an increase of the 15,000, and so on and so forth. Be careful with the credit side of things. Notice the prior year had 53,000. We got 58,000 here. So this negative number, or this credit, is an increase. It increased in the credit direction. It's useful to format it in this way because that's going to help us with the statement of cash flows under the method that I would typically be working with. So then we have our information down below. This is a post-closing trial balance for the prior year, so there's nothing in here after the equity section because the temporary accounts have been closed out to retained earnings or the non-controlling interest. And then on this side, we do have the income statement accounts down below, so we can be using those. And there we have that. So our worksheet, we're going to have the cash flows from operating activities, cash flows from investing activities, cash flows from financing activities. And we're basically going to be populating this. This will be our statement of cash flows worksheet. The cash flows from operating activities, you'll recall, can be done using either a direct method or an indirect method. These kind of reflect, in essence, the income statement, where you can basically take the end number, net income, reverse back into the income from operating activities, or cash flow from operating activities. Or you could use a direct method, in essence, basically recategorizing each line item from an accrual to cash method. When you do that, however, when you do the direct method, which I think is a really nice method to be able to speak with other people about, because it's more intuitive for someone to read, because they see it. Oh, you could basically say, hey, look, we basically took kind of like the income statement and we made it into a cash basis method, and that's basically what we have. That's more intuitive to look at, but it doesn't provide the reconciliation that the indirect method does, which actually ties out the net income, the difference. What's the difference, in other words, between the net income on an accrual basis and the cash flows from operating activities? There's not a reconciliation. So sometimes regulations will still require, even if the direct method is used, some kind of reconciliation, such as this reconciliation of consolidated net income to net cash provided by operating activities, which is in essence the indirect method, which is why a lot of people will still just use the indirect method maybe sometimes if that's the case, because it'll be less work. But I do think the direct method is useful, and I do think it's more intuitive for the reader of the financial statements. So if you think about these two methods, most people might have more experience with like the indirect method, and it might be easier than to actually look at the reconciliation and then go back in and do the direct method. So let's take a quick look at like the reconciliation side of things, and that will be the indirect method, and then we'll do this with basically the direct method. So the reconciliation of consolidated net income to net cash provided by operating activities, similar to basically the operating activities under the indirect method, would start with, in essence, net income generally. But as we saw with a prior presentation with a similar problem on the indirect method, we're basically taking everything except that non-controlling interest. In other words, this is the net income on our trial balance format, including the non-controlling interest. If we were to remove the non-controlling interest, we'd have $77,500, and then I'm taking out that $9,750. So we'll take out that $9,750. So I'm going to say plus $9,750, and that's going to be the $87,250. So that's going to be our starting point. Now, as we consider this, it's often useful for us to think about these items as changes in the balance sheet accounts. So we might want to then think about that as basically a change in the retained earnings accounts. So we kind of got a change in the retained earnings accounts. If we looked, or the retained earnings or equity in general, if we look at the change in all the equity accounts, the prior year we have a post-closing trial balance, so everything's closed out, income statement is closed out. Current year, we have the income statement accounts down here. So basically, if we took this change for all of the blue accounts, that would basically be the change in the equity accounts. So if we kind of reconcile what that is down here, what that change is, this is going to be the major component, basically the piece of the net income. But let's think about that entire amount, that entire difference. In other words, let's pull out the trustee calculator here, and let's say, okay, what if I took this 33,000, I'm taking these numbers to the right, minus the 4,000, minus the 485,750, plus the 247,320, plus the 54,000, plus the 36,500, plus the 14,000, plus the 1,000, plus the 46,000, plus the 9,750, which is going to be this 48,500. What if I took that change in equity, that total change in equity, and reconcile it to then this 87,250? What's going to be included there? Okay, that's going to be our issue. We're going to say there's that. We're going to say this amount then, the 9,750. We're going to reverse that out. That's going to be one of the components. Then the non-controlling interest in NA. So the non-controlling interest up top is going to be reversed out. So we'll have that. And then we have the dividends that were paid. The dividends paid are going to be included in this difference in retained earnings, are going to be the dividends. And that's going to give us this 87,250, which is basically going to be our starting point. So we're in essence going to have to account for some of those other changes. These two up top, the 97,50 and the 4,000 net together to that 5,750. We'll see that later as dividends paid to the non-controlling shareholders. We'll see the dividends down in the financing activities. Okay, so then we've got our net income. Then we're going to have the adjustments for the net income. We've got our difference in our depreciation, which you could see on the income statement. Or if there's no other activity, once again, that will also be the change in the accumulated depreciation, which is what I would pick it up as. The change in the accumulated depreciation is what I would think of it as. If that number is different than the dividends, then you're going to want to, I would mark it out and use this number and then go back and figure out the more complex transaction by looking at the activity and the detail in the general ledger for that account. Amortization, same thing. We have our patents here are amortized, and we also have the amortization expense on the income statement. I would think of it as the change in the balance sheet account because we're looking for those changes in the balance sheet accounts. We already picked up the change on the income statement when we're considering the net income itself. So then again, if that's different, if that number is different than the amortization, then you're going to want to dig down on it and see if there's any more detail to it. You're going to have to include in that sense. So then we're going to have the changes in the operating assets and liabilities. So the change in the receivables, there was an increase of $15,000. The way our worksheet will work is we're always going to flip the sign. So I'm just going to flip the sign. I'll do this quickly because we did this one in a prior presentation, the indirect method, but we'll flip the sign. 15,000 negative, change in inventory is 8,000 here. It's 8,000 negative here. Change in accounts payable, we're jumping down because the land and the building, those are going to be in investing activities. So we're down here in the payables, 5,000. We're flipping the sign once again to a positive 5,000. Then we have the wages payable, 6,000. We're flipping the sign to a negative 6,000. Total adjustments then are going to be all these items from the 36.5 down to the 6,000, adding up to the 13.5. Then the net cash provided by operating activities will be that 100,750, the 87,250, and the 13,500. We will of course get to that same number, the 100,750, using the direct method shortly. So now let's go on down and do the same thing with the direct method. So we got cash flows from the operating activities. What we're going to do now is we're going to say, now let's basically take each line item of the income statement, and instead of kind of backing into it, instead of taking basically net income and backing into the cash flows from operating activities, let's go ahead and take each line item of the income statement and turn it into basically a cash basis method in essence. So therefore, we're going to think of basically the revenue account as cash received from customers. So we've got cash received from customers. This is on an accrual basis. So how can we convert that? What are going to be the accounts that are involved in the cycle that we can then create it from an accrual back to a cash basis? Well, we can take the sales number there. The other thing that's going to be involved is the accounts receivable. So we can take that change in the accounts receivable. Now, I'm not going to go into a lot of detail on why would be a debit or credit or exactly how that works. We could spend a lot of time on that. That's something that you might want to look at in more depth in just a cash flow statement. It's something that I don't think a lot of people, even in public accounting, have a really firm grasp on. So I think it's worth looking into that in more detail, but that's not something that's different from the cash flow statement for a direct method using a consolidation to just a normal cash flow statement. So I'm not going to spend a whole lot of time on that here. So, but in any case, that's going to be the 470,750. That'll be up top, 47750. Cash paid to suppliers. We could do a similar type of worksheet down here. There's going to be more things involved. Cash paid to suppliers. We're going to think of the cost of goods sold account included here. The other expenses which will be included here. Then the inventory, which is an asset account up top, is going to be included in this basically cycle, the change. And then we're going to take the accounts payable, also included in this cycle. So we're going to be combining those together. Again, I'm not going to go and spend a lot of time on breaking that down exactly why. You can see that these accounts will be included in the cycle. And then we're going to say that that's going to come out to the 296,000. So there's going to be the 296,000. Then we got the cash paid to employees. Cash paid to employees will of course include the wages and the wages payable. The wages payable difference here, that change in a similar way as we've seen in the prior one. That's going to be the cash paid to employees, the 60,000. That's going to be cash going out, of course. So we have the negative 60,000. Then we've got cash paid for interest on the notes payable. Cash paid for interest is going to be pulled directly here. So there it is, the 14,000. If we add those up, then we get to the 100,750. That 100,750 should then, of course, match what we got when we did the reconciliation of consolidated net income to cash provided by operating activities. So these are the major two components. So once again, I think this, if you were to show this to someone who doesn't really understand a cash flow statement, it's easier to say, hey, look, here's basically the sales, and then there's the cash received from customers. Here's basically the expenses going out on a accrual basis. Here they are basically on a cash basis. I think that's easier to get to. But note that we don't have, using this method, this nice reconciliation between this number, the 100,750, and basically the net income, as is done by the indirect method, which actually gives you basically the net income, the consolidated net income, and then the adjustments to basically to reconcile to the cash provided by operating activities. So that added reconciliation component is generally what is used, or why a lot of times the regulatory bodies will still want a indirect method or a statement of reconciliation, even when doing a direct method. But I still think there's value to the direct method because I think, like I say, I think it's more intuitive for people to look at a lot of times. Now, the rest of it, we're going to go down here and just continue on to the cash flows from investing activities. This, of course, will be much the same as it'll be the same as an indirect method, direct method, because the difference, of course, is in the cash flows from operating activities. So if we go to the purchase of land, we see that land increased. We're going to assume that increase was cash paid. Once again, I would make that assumption first, just like what we talked about in the prior presentation to this with the indirect method. I would think about that first, and then if it's more complex than that, then go into the complexities of it. So we assume we paid cash there. Same with the building. It went up by $35,000. We assume more building was purchased. We're going to assume it was purchased with cash, but it might be more complex than that. If so, then I would use the $35,000 now, mark it off, and then go back to the more complex activity in the future when you have more time and you have basically reconciled this thing. And then we have the net cash provided by investing activities, the 10 and the 35, adding to the 45. Cash flows from financing activities is, of course, next. We have the notes payable, had a change of the $15,000. It went up by $15,000. Therefore, we're assuming that more money came in due to taking out a loan of the $15,000. Could be something different. Maybe there's multiple loans. Maybe something happened in combination with taking out a loan for another. For these items up top. But again, I would look at that measured change first, mark it off, then go into the GL, check out any more detail, and then do the more complex transaction, kind of like a journal entry in a systematic way, so that you can focus on one thing at a time. Dividends paid to parent company shareholders, that's going to be the $33,000. That's going to be the difference in the retained earnings here, because this is the retained earnings. Retained earnings includes dividends and whatnot, and so that's going to be the change that happened, the dividends, and that's going to be a negative because we paid the dividends out. The dividends paid to the non-controlling interest is going to be one of our differences here from the consolidated statement of cash flows to the non-consolidated. So we got the 23,000 times the 0.25, was it? I think it was. And that's going to be the 5750, which again you can also think of as if when we went back up top, that's that 5750 for the dividends paid. When we looked at our reconciliation of, in essence, the the net income and the total retained earnings. So there we have that. Then pulling the calculator back out, we have the net cash used in the financing activities is going to be the 15, the 33, and the 5750 for the 23,750. The net increase in cash then is going to be the cash from the operating activities, the cash used in the investing activities and financing activities, the 100,750 minus the 45,000 minus the 23,750, giving us that 32,000. Then we're going to be picking up the beginning balance, the 81,500. Here's the 81,500, and that of course will pick us up or take us to the cash at year end, the 113,500. That then should match the balance sheet and our trial balance for the current year end. So that's going to be our ending numbers. Here's just a quick scroll through. Looks very nice. All right.